Hello, this is Corner Invest. So we will have massive earnings coming up this week. So in today's video, I'll be covering a few things. I'll be covering earnings this week, stocks that I'm looking to own from this earnings season, as well as some comments and questions that you guys have left in the comment section. So we have earnings coming up this week, and on Tuesday, we have massive earnings from Moody's as well as Tesla. These two are the notable companies on Tuesday. And then on Wednesday, we'll have Lam Research as well as Chipotle. These two are the bigger companies here. And then on Thursday, we have the big one, which is another Mac 7 company, Alphabet of Google. We'll see if they can beat their earnings this time round. So this is the first stock over here that I'll be talking about is Moody's. So Moody's is currently down around 10% year to date, and it is currently trading at around a 37 times earnings. So for Moody's over here, if you're to look at the earnings history over the past few years or so, it's been quite consistent. The only time where they had a lot of misses was in 2022 when we had the interest rate hikes. So during this period over here, the Fed, they increased rates at a record speed, and that hurt Moody's earnings because people, they didn't want to raise debt, they didn't want to go and borrow debt, they didn't want to sell their debt, and that led to decreased action and decrease in activity of the credit market. And that's why you saw this portion over here where Moody's had a lot of earning misses. But ever since then, this company has been quite resilient. After 2022, it has been beats and beats and beats and beats over here. And we were seeing that up till 2022 as well. This company has been extremely reliable in terms of their earnings. Earnings have been beaten almost every single time for this company. So this is Moody's earnings from last year. Last year, they grew revenue by around 20%. They grew free cash flow by around 34%. So this is incredible growth for this company. The company likely grew because of this Moody's Investors Insight portion where they basically rate a lot of your different debt. So in 2022, the credit cycle went down because the Fed, they increased rates at a record speed. But they've since started cutting rates, and that is why you're seeing an increase in debt activity, and that is why you're seeing an earnings growth for Moody's as well. So for Moody's over here, there's a few bull cases. So number one, it'll be interest rates dropping. So when interest rates drop, people will be more inclined to go and borrow debt, to go and raise debt, and that will help earnings for Moody's because Moody's, what they do is they just rate all the different bonds that people try and sell, and then they just take a portion of that total bond value. And when your bond issuance increases, then Moody's earnings will increase as well, and bond issuance will likely increase when your interest rates come down. Next portion over here, next tailwind. So the other tailwind for Moody's is the debt maturity. So over here, we're expected to increase in the debt maturity all the way until 2028. So this is a natural tailwind for Moody's over here, and we will likely see an increase in earnings all the way until 2028 where the debt ceiling and the debt wall basically peaks, and then it will start tapering off after that. So this is a very obvious tailwind for Moody's, and that is why you're seeing Moody's, S&P Global, both having around 15 to 20% earnings growth last year and projected to have around a 15 to 20% earnings growth this year as well. Next stock is Tesla. So Tesla is currently down around 36% year to date, and this company is trading at around 118 times earnings. So for Tesla over here, it is a stock that is very much sentiment driven. It's not so much valuation driven, not so much fundamentals driven. It is more of a story that Elon Musk paints, and all your Tesla investors, they're not so concerned with the fundamentals itself. They're more concerned with the story as well as Elon Musk heading the business. So for Tesla over here, they've been hit really hard recently. So your sales over in Europe has been dropping in almost every single country. So why? Because Elon Musk is basically treated like as though he's a villain now. So because of his association with Donald Trump, he's being treated like a villain. So for Tesla over here, this is the story. They're creating sort of like an ecosystem where you have all the different components of the business coming together. So you have your energy side, you have your robotaxi side, you have your memory side where they collect data from the roads and all these people driving the Tesla cars. And then they have their Tesla automobile side as well. So you can see all these different components coming together and creating this brand for Tesla. And that is actually what they're trying to sell to all the different stock as well as consumers. So for Tesla over here, this is their earnings history. So as you can see, earnings has been up and down. It's sort of like a wave, and it's not predictable at all. So for a Mac 7 company to have earnings like this, I don't think it is a quality business, and that is why Tesla is, for me, a company with a weak moat currently, unless they can build up the robotaxi fleet and have everyone using their robotaxi app. So this is Tesla's earnings from last quarter. So last quarter, they had a double miss. So EPS came in slightly lower than expected, revenue came in slightly lower than expected as well, and then net income dropped around 71% from a year earlier. So that is why I'm not invested in Tesla. The stock has always traded on stories, and that is what I don't like for my companies. I want my companies to grow in line with fundamentals and have some maybe multiple expansion here and there, but I don't want the whole stock return to be just from multiple expansion, because at that point it becomes dangerous, it becomes speculation driven rather than fundamentals driven, and that is what I don't like about some of these stocks over here. Next stock is Lam Research. So Lam Research is another wafer fab equipment company over here. It is one business that is quite vital to your semiconductor chain over here. So this company is trading at around a 19 times earnings. It is down around a 12% year to date. And together with the semiconductor industry, it has dropped since the start of this year. So this is Lam Research and the semiconductor earnings so far. So ASML, they reported earnings and they missed their earnings slightly. And TSMC, they also beat their earnings, but the earnings reaction wasn't the best. It was up around 0.5% on Friday after it released its earnings. So far, earnings have been great, but tariffs has sort of like hurt all the different guidance and all the earnings from all these different semiconductor companies, because all your semiconductor companies, they rely quite heavily on China. They have a large portion of their sales to China. So for example, ASML over here has around 20% of the sales going to China. TSMC has quite a portion as well, and then you have all your semiconductor companies that have a large chunk selling to China as well. So if this tariff portion just intensifies, if this tariff war basically exaggerates itself, then you can see all these semiconductor companies being hurt as well, as we saw with Nvidia a few days ago, when the US government, they basically just blocked Nvidia selling their chips to China. So this could be a problem for all your different semicon companies as well, and that is why we've seen sort of like a very muted reaction to their earnings, although their earnings were quite amazing. Next company is Chipotle. So Chipotle is a company that is owned by this famous investor over here, his Bill Ackman. He's been cutting his Chipotle stake, but he still has around 20% of his portfolio in Chipotle. So Chipotle over here is a company that is now 19% year to date, and this stock is currently trading at around a 43 times earnings. So a 43 times earnings is quite a hefty price to pay, especially for a company that is operating restaurants. So for Chipotle over here, the earnings history has been quite remarkable as well. They almost haven't missed a single earnings all the way before like 2010 or so. And yeah, it's been growing, it's been extremely stable, and this company is not maturing yet, it's still growing at a relatively fast rate. So this is Chipotle's earnings from 2024. Revenue grew by 15%. For a restaurants business, it is quite incredible, and you have comparable restaurant sales up 7.4% as well. So this is one of the most important metrics when it comes to your restaurant companies. You want comparable restaurant sales to increase, you want comparable restaurant sales to be positive. Whereas for companies like McDonald's, they're struggling to have positive comparable sales. They're having around a 0.5 to 1% comparable sales, and you have companies like Chipotle having 7.4% increase in comparable sales. Just incredible. And this business is increasing in all fronts as well. So diluted EPS grew by around 24%, and then you have adjusted EPS growing at around 24% as well, and they're opening up new restaurants as well. So this business is operating well in all fronts, increasing earnings, increasing revenue, increasing margins, and overall, it's an incredible business if you want to own a restaurant company. So the bad cases for Chipotle is simply just the consumer confidence weakening. So over here, as you can see, the consumer confidence has been on a decline ever since 2022 or so. So we're currently at a very low point as compared to history. In 2022, it dipped to a very low point, and now we're approaching that point as well. So if the consumer dollar starts to hold back, then you can see Chipotle earnings start to come down. So for Chipotle over here, is it time for you to go and buy Chipotle? So Chipotle is not the widest moat company in the entire world, but it's a company that everyone loves. So everyone loves food, everyone needs food, and that is why you're seeing all these restaurant companies coming up and doing well as well. Some of them even better than your tech companies. So for Chipotle over here, they do the simple thing. They just open up restaurants, sell more food, and then they just repeat that process. And that is a very sort of like predictable way for you to do it, although it is not a company that is of the widest moat. But for Chipotle over here, this company is an avoid, because this company is currently trading at around 40 times earnings. So for a company growing at around 15% or so, I don't want it to be above a 30 times earnings. And for a company that doesn't have an extremely wide moat, like a restaurant company, because it doesn't have any sort of like IP or any network effect and so on, this company shouldn't be trading at around 40 times earnings unless it grows at 40% or so. So that is why I'm not looking to buy Chipotle unless it drops to around a 20 times earnings compared to all your different other restaurant companies as well. Then I could be interested in buying Chipotle because it's much higher growing. But for now, I'm staying out of this business. Next stock is Google. So Google is a company that's down around 20% year to date, and it is currently trading at a 19 times earnings. So you have a company, a Mac 7 company trading at 19 times earnings. That is actually quite remarkable. So these are some of the concerns about Google. So the main concern that everyone has about Google is just ChatGPT killing search. So you have your increase in all the different LLMs as well as AI agents, and that is the argument that everyone is making when it comes to Google. People think that Google search will be replaced by all the LLMs. But if you're to look at what Google has been doing over the past 1 year or so, Google has been slowly integrating AI into search. It included Gemini as well into your search, and they've said so far that Gemini AI search has been equally profitable to their Google search business. So they're essentially saying that LLMs are not killing the business. And the other argument is that LLMs will steal volume and take volume away from Google. But if you were to just look into the numbers itself, Google search has been increasing in volumes ever since those LLMs came out. So it is not a very strong argument now yet, although it is a very possible one in the future. So for me, I'm still not concerned about Google until the numbers show, then I may look to sell this stock. So this is Google's numbers over here. So as I said previously, until it shows in the numbers, I won't be selling this stock. And over here, you can clearly see that this is a company that is operating well in all fronts. So there is no reason for this company to grow at around 15% and to trade at around the 19 times earnings. That signals a deep value of undervaluations. So I do believe that this stock deserves around a 25 times earnings, and it will take time for the markets to adjust. And sentiments are bad right now, so it's a good time for you to look into Google if you're looking to hold this one long term. So this is Google's valuation over here. Earnings has been exploding, and that is why you're seeing sort of like a suppression in its price to earnings. It's currently trading at a valuation that is lower than 2022, and its earnings grew by around 38% last year. So this is a company with a stock price that is getting detached from its earnings, and that is when you will try and get into this stock to try and get outsized returns. And that is why I have Google as quite a substantial position in my portfolio today. So in summary, I'm bullish on Google. It's cheap, it's high quality, and the growth and predictability is there as well. It isn't the highest quality Mac 7 business. It is certainly a top 10 in terms of its predictability as compared to all your different other S&P 500 companies over here. So that is why I have an outsized position in Google. I'm hoping to hold this one for the very long term. Let's see how it goes. So this is why I'm bullish on Google as well. So this is from a Reddit transcript, and someone said over the last few months, he was extremely bullish on Google for multiple reasons, such as Gmail, but that changed today as it turns out, after deep research, that Google's revenue is from search, which has a good chance of disruption from AI startups such as ChatGPT and Gemini. So, ironically, Gemini was created by Google. So, this person is thinking that Google is a value trap right now, and he is thinking of initiating a large short position on Google on April 21st. So this is when you see sentiments changing, and this is typically when you want to buy into this stock. When sentiments are crap, when the stock price is depressed, when the stock price valuation is extremely low, that is typically when you want to get in. And this just fuels my bullishness on this company over here. Last portion, I'll be talking about some of the comments and questions that you guys had in the comment section. So the first comment is from this guy over here. He asked, what do you think of the current valuations of PayPal, American Express, Union Pacific, and Siemens? I'm not too sure what Siemens does, so I'll be striking that one out. So let's talk about PayPal, American Express, as well as Union Pacific. So PayPal for me is a business. It is a business that is facing a lot of competition, but I think for current valuation today at around 15 times earnings, and them having a buyback yield of around the 6 to 7%, and revenue growth of between 5 and 6% as well, you can easily see this company growing at a double digit in terms of its EPS over the next few years. And for a double digit EPS growth trading at around 15 times earnings, I think PayPal is a business that is trading at a valuation that will give you outsized returns in the future as well. But for me, I'm not looking to buy PayPal because the predictability is simply not there. They face too much competition. For me, there are better companies out there similar to American Express as well. So American Express is sort of like a payment processor. It's a bank as well. It has all the different components of a bank system included in the business. But for me, American Express is simply not cheap enough. I already have a high quality business in Visa, so there's no point in me buying into American Express unless the valuation really makes sense. Next company is Union Pacific. So I believe Union Pacific is one of the higher rated ones in terms of the railways, in terms of valuation. So for me, there are better alternatives out there as well. You have Canadian National Railway, you have Canadian Pacific. Those two companies are much better in terms of valuation currently as well. And so I wouldn't buy into Union Pacific. Canadian National Railway is a company that I've been looking at as well. It didn't trade below the price that I wanted to enter in, and so it's not a company that I'm looking to add. Same thing for Union Pacific over here. Next company that I'll be talking about is Hims and Hers. So this guy over here, he asked, what do you think of Hims and Hers? So for me, Hims and Hers is a high growing business, But the problem with the business is it lacks predictability. So it's like a telehealth business. What they do is they sell all your discrete drugs for erectile dysfunction, for all your different other problems as well, like obesity and all that. And they operate in a subscription business model. So the business model itself is not too bad, but the problem is there is no barriers to entry. So you have Amazon creating a similar service as well. And I believe there'll be other companies that are coming up with all these different services as well as competitors coming into the game as well. So for me, Hims and Hers, it is a company that is growing extremely quickly, but there are two risks for this business. Number one, there's no predictability. There could be competition coming into this field as well. And number two, they rely too much on compounded versions of the weight loss drug. And when those drugs come off the shortage list, then you will see Hims and Hers revenue dropping in terms of its growth and so on. So for me, Hims and Hers is an avoid. It's a company that is trading at a decent valuation right now, not too expensive. But for me, I simply don't understand the stock enough for me to invest into it, and I don't think it's predictable enough. Last one, good video. Please explain why MSCI is a good business in the next video. So why exactly is MSCI a good business? So what MSCI does is it issues license to all your different ETF managers, all your different asset managers, and it just basically create an index and then just license it to them. So it is an incredibly asset-light business. The only real capital cost is human capital cost. So for me, if you're to look at the world indices, the only company that is providing actual world indices is your MSCI World Index. And MSCI is sort of like in a duopoly with S&P Global, which operates your S&P 500 as well as your Dow Jones. So for me, MSCI is an incredible wide moat business. If you were to just look into the numbers as well, your ROIC, your revenue growth, your EPS growth, and so on, MSCI is an incredibly durable business, and it's a company that is able to grow revenue even in an economic downturn. So in 2022, when we had the stock market crash, even though MSCI's earnings is linked to your assets under management, meaning to say if your assets under management comes down, then MSCI will have less earnings. In 2022, despite of those stock crash, MSCI's revenue grew around 8 to 9% as well. So even in an economic downturn, this company can still grow because it has a lot of secular tailwinds going for it. So you have population increase, you have more people coming in and investing in the stock market, and that is when you'll see MSCI's earnings growing in the future. MSCI is an incredible business. It is one that I have in a portfolio. I'm looking to increase my allocation into this stock. It hasn't reached a point where it is extremely undervalued. And so for me, I'm just waiting. I'm waiting for this stock to retrace all the way until $450 before I add my next tranche into this business. Hopefully you guys have found this one useful and invest safe.